makers and market movers. This is The Pulse with Francine Lacqua.
Good morning and welcome to The Pulse. I'm Tom McKenzie in London. Here's what's coming up on today's programme. Apple jumps as it forecasts a return to sales growth. The iPhone maker announcing a $110 billion share buyback. That is the biggest in US history. Traders pull forward Fed rate cut bets by a month to November ahead of today's key US jobs report. Plus, SocGen soars as revenue from its equities traders help the French lender beat profit estimates. We will unpack a busy week of earnings for the European banking space. Also ahead, I'm going to be speaking to the Governor of Virginia, Glenn Youngkin, about his trade mission to Europe. Let's check in on these markets then. Yes, there's the optimism coming through from the tech space on the uplift from Apple and the expectations that this quarter is going to prove a little bit more positive in terms of sales. But then there's the banking story as well, feeding into what we're seeing over in France, where the CAC 40 is putting in a solid day. The FTSE 100 also, as you can see, in positive territory this Friday. In terms of the upside coming through for the French markets, you're seeing gains of 0.3%. Credit Agricole and SocGen both coming through with decent beats, adding 25 points so far on the CAC 40. Here in the UK, the FTSE 100 up 23 points at 8,195, just skirting that 8,200 level. Over in Germany, the DAX up 0.2%. Cross asset, we're looking at the 2-year, of course, in the lead up to the jobs data out of the US. The forecasts are for an increase of 240,000. There will be a focus on the wage component and how that ties into the thinking of the Fed, of course. And as we said in the headlines, markets now bringing forward the first cut to November from December. We'll see how that moderates on the back of the jobs data. 488 currently on the 2-year after a pretty significant move lower in yields over the last couple of days on both 2s and 10s. The Japanese yen and the currency there remains a focus for us today as well. Look at the strength there. 160 seems like a long time ago, but it was only earlier this week. 153 exhaust on intervention speculation that continues, but how long will that remain the case for the Japanese yen? The relative strength that we're seeing up 0.2% so far in the session. Of course, the US story is key for the outlook for the Japanese currency. Brent trading at $83 a barrel, 86, 83, 86, 83, 87, up 0.2%. A little bit more calm, of course, in terms of the geopolitical angst. We keep an eye on the oil markets, the inventory build-out and stockpiles in the US. The red head crossing the turmoil when it comes to the Central Bank of Norway, as expected, keeping its benchmark interest rate at 4.5%. The central bank saying that tight policy may be needed for somewhat longer. That is crucial because we know the currency, the krona, has weakened. Yes, dollar strength is a component there, but with inflation around that 4% level in Norway, there has been concern amongst some that the weaker currency could lead to further increases in prices. Those import costs, a concern for officials, and therefore you're getting this redhead, the Norges Bank, the Central Bank of Norway, saying that tight policy may be needed somewhat longer. And we'll see if they still pencil in September for the first rate cut. That had been the expectation. Again, the Central Bank of Norway keeping interest rates at 4.5% as expected, saying monetary policy is having a tightening effect, says the rate is sufficiently high. The rate is sufficiently high to return CPI to its target. Let's get back to the big corporate story of the moment, though. We talk about the earnings story, but we also talk the bank earnings story, but we also talk about what came through from Apple. And a surprise, their expectations have been pretty low, frankly, given what we've been seeing in terms of the reporting around the sales out of China. Apple up over 5%, 5.6%, as you can see, pre-market, after those stronger than expected sales last quarter. And a forecast for a return, this is really important, a forecast for a return to growth in the current period. The tech giant also planning the biggest share buyback ever. And that grabbed some headlines and raised some eyebrows. Matt Bloxham from Bloomberg Intelligence is here to break it all down for us. Matt, what do you make of what we've been hearing from Apple?
Yeah, I mean, it's certainly more encouraging than people expected, and China is the big story. I mean, China's been the big story for the last few weeks, given that we've had negative channel checks about their iPhone performance there. But actually, China's sales came out better than expected, about $500 million better. That was enough for the overall beat. And actually some more optimistic commentary from Tim Cook on the analyst call about their positioning in China and the fact that iPhone sales grew in the quarter and that it's a very popular device in urban China, holding the top top 2 spots in terms of popular smartphones. So he was optimistic about the outlook. There's clearly issues around some of their other products in China, but we've seen that across the board. If you look at their iPad sales globally, down 17% year on year in the quarter, and they've got a refresh coming next week on that, so that may well help in China as well as the rest of the world. But analysts on the call were really kind of questioning, this doesn't make sense. You've done better than we thought in China. This doesn't really match up with what we've been seeing in the channel checks. Explain. And they didn't want to. But what they did point to was that they see, look, there's more and more people in China moving into the middle class. Apple's an aspirational brand, and so that gives them confidence that over the midterm, ignoring the quarter-on-quarter trends, that still leaves them in a good position for what's an enormous market.
There's been a lot of hand-wringing about China, but also a lot of hand-wringing about the lack, as some would see it, of a clear AI strategy for Apple.
Yeah.
Did they address that in the call?
Ever so slightly. Obviously, they've got the Worldwide Developer Conference coming up in June, and that's where they will lay out in more detail their AI strategy. The hint we got from Tim Cook yesterday was that they think they've got something different to bring to the table because of their combination of hardware, software and services, and their big focus on privacy. So I think tying all those things together, they'll try to kind of craft something incredibly convincing at that conference. But that might give people optimism about the iPhone refresh coming up in September, and whether we might see significant changes in the kind of hardware configuration or OS on top of that, that maybe kind of prompt more people to upgrade their phone or spend $1,000 or more on a new phone. Because obviously everybody in the smartphone world has been struggling with this longer replacement cycle, and maybe a significant refresh around AI might shorten that, give people more optimism about the midterm.
OK, Matt Bloxham, thank you very much indeed. Breaking down the Apple earnings, not mentioning the Vision Pro, which maybe tells you everything you need to know about the importance of that part of the business, at least for now. Maybe things will turn on that. But of course, looking ahead to June as well, which will be really consequential, as Matt says, in terms of the detail on that AI strategy for Apple. Let's go macro now, with the OECD's latest economic outlook putting Britain at the bottom of the G7 growth league next year. The think tank downgraded its UK forecast for both 2024 and 2025, citing tighter macroeconomic policy. Alvaro Pereira is the incoming chief economist of the OECD, taking over next month. He's currently director of policy studies. Welcome to the show, sir. Thank you for your time. Let's start on the question of the UK then, because I can almost hear the politicians responding here in the UK by saying, once again, one of these international organisations is underestimating the growth of the UK. How confident are you in this downbeat assessment of the UK's economy?
Well, first of all, I would like to say that we forecast growth for the world economy around 3.1% this year, and more or less the same thing for next year. In terms of the UK forecast, it's within what we see also in the tendency in Europe, which is basically very sluggish growth this year, and picking up next year. We forecast more or less the same thing for the UK. Well, this is due to a plethora of factors. The UK has been underperforming in the past few years, with lower investment than other parts of Europe, but also this time around, obviously, monetary policy is doing what it should be doing, which is basically, by being restrictive, to be able to cool down the economy. And this is important because, as we know, Europe and the UK were subject to a massive energy crisis, much bigger than it happened, for example, in the United States. We calculated that at the time, about the peak of the energy crisis, that the impact for economies like the UK and Europe, the impact was bigger or as big as in the 1970s. And it's kind of natural that afterwards, since real incomes went down quite substantially in the UK, and this affected consumption, when investment is already sluggish, it's quite natural that the UK economy is not doing so well. The same thing for the European economies too, with the exception of Spain, by the way.
And we'll zoom out to get your views on the global economic picture. But just one more on the UK. Is it your assessment then, given the data that you're seeing, given your view and your outlook for the UK economy, that the Bank of England could diverge from the Fed, that the BOE could go earlier and cut rates?
I think, for the Fed, for the ECB, for the Bank of England and other central banks, this is all going to come down to, what the data is going to tell us, right? So what we've been seeing around in many countries is that we've been having a significant decline in goods inflation. This is partly because of the lower energy and food prices, but also because, generally goods inflation came down quite significantly. But on the other hand, even though core inflation is coming down, we know that service inflation continues to be fairly sticky. And this is due either because of markups or because obviously unit labor costs, but also unit profit costs, which were higher last year, and now they came down. And all this contributes to a sluggish decline in service inflation, and this has an impact, of course, on the decisions of the central bank. So I think if there's going to be a divergence between the Fed and the other central banks, it's going to be really data dependent. If we see that service inflation comes down faster in these economies than in the Fed, then it's possible that this will happen. But again, I think the next 2 or 3 readings are going to be quite important for us to see what happens.
Which parts of the global economy are most vulnerable? You forecast 3.1% global GDP growth this year, 3.2% potentially next year. Which parts of the economy, the global economy, are most vulnerable, though, in an environment where rates are still at close to 3-decade highs?
Well, one thing that is important to say is that we see that early signs that a recovery is unfolding. Growth is not spectacular, but we're talking about decent growth in several parts of the world economy. We see, for example, that trade is starting to pick up, and we forecast that trade this year will pick up to 2.6%, which is very welcome compared to what we've seen recently. We see that the growth has been more or less pervasive. Latin America a bit less growth, but again picking up more at the end of the year next year, and partly because of the commodity prices as well, but not only. We see North America, in terms of the United States, very robust growth right now. And we forecast that it will continue also next year. Europe is vulnerable right now, and we see many economies like Germany and France having much lower growth than we had anticipated, partly because of the energy crisis or the ensuing energy crisis and the consequences, but also because of that consumption and investment not recovering as fast. We see Asia as also a bright spot, but including China. Even though we've been concerned for a few years with the adjustments that need to be done and are undergoing right now in China in the real estate sector, we think this adjustment is important to be done, and also to be able to lower the significant private debt that still exists. In economies like in Europe and the United States, something that we are concerned is certainly what
Alvaro. On China, I just want to follow up on that. In terms of the growth picture there, what is your outlook for growth from China then? And is it the right kind of growth? Are they engineering the consumer and the consumer impulse that many economists say is needed in that economy?
Well, we are forecasting 4.9% this year for China and 4.5% next year. And so compared to what happened in the past few decades, it's certainly lower. But we also think that there are significant risks that growth could be lower than that. Of course, there is the authorities are bringing fiscal stimulus to the equation, and so that will help. But obviously, it depends how smooth the adjustment to the real estate market will unfold. We think this is, as I said, we've been highlighting this for several years. We have been concerned about private and quasi-private debt that China has. And since the real estate market was, as a percentage of GDP, much bigger than we've seen in many other economies, we thought that some adjustment had to occur, and it is occurring right now. So, right now we see that things are relatively going relatively okay, even though the risks of that the adjustment will not be as smooth are significant still.
Just briefly, you talk about and you note a pickup in trade dynamics. How vulnerable is that evolution in trade to a potentially more protectionist president? I'm thinking, of course, of Trump in November. If that comes to pass, there is a fear of additional tariffs and more protectionist US. How vulnerable is trade to that prospect?
I think what we've seen since the global financial crisis is a significant increase in protectionist measures around the world. We measure exactly the number of protection measures that we see in G20 countries, and we see almost every year it has been on the rise. And if we turn even more protectionism, independently who that is, obviously this will have an impact on trade. And right now we are seeing that in spite of this increase in protectionism in the past few years, we still see we're starting to see a little bit of a better growth for the world trade growth. But obviously it's going to depend whether we continue to have open markets, which we hope that will happen, or if we have an increased tendency of protectionism. If obviously if there's increase in protectionism, it's very likely that world trade will be affected.
OK, thank you very much for your time. Your analysis, of course, on this global economy. Alvaro Pereira, incoming chief economist at the OECD. Really appreciate it. Coming up, bond traders pull forward bets on a first Fed cut to November. We're going to take a look at the numbers next. This is Bloomberg. Welcome back. Now, bond traders have pulled forward expectations for the Federal Reserve's first full interest rate cut by a month to November. Next on the radar, of course, is the key US jobs data out later today. Let's get the analysis then and the preview on that data. Bring in Bloomberg MLive's Ben Ram. Ben, in terms of the Fed, the repricing, talk to us about the rationale, what we've been seeing there. What's been driving that shift, essentially?
Well, morning, Tom. So, there's a lot that's been priced into the front end of the Treasury market. And, investors have gone from thinking 6 rate cuts at the start of the year to just about 1 and fractional at the moment. Obviously, what has driven that shift is the expectation that the Fed will have to stay higher for longer. And it does look like the economy is not going to afford the Fed any room to cut rates anytime soon. We saw a marked, pronounced disinflationary narrative through much of last year when headline inflation went from 6% to 3%. But since then, inflation, as you know, has been sticky. And that kind of last mile of disinflation is proving very hard for the Fed to conquer, which is keeping them on hold for the time being.
And then when it comes to the jobs data today, how is that going to tie in to the pricing around the Fed, the expectations as to whether or not November really is the month in which they land with this cut? And what are you going to be scrutinising within that data?
I think, the headline expectation for today's number is about 240 is for a print of 240K. But what is interesting to me is if you look at the distribution of expectations today, they're all fairly skewed to the left, meaning more people expect a weaker number than the people who expect a stronger number. As for me, I'll be watching 2 things. One is the jobless rate, which is 3.8%. The Fed thinks that we need a 4% rate or even higher to bring the jobs market into balance. Even more crucial to the market's calculus will be the hourly earnings number. That is forecast to come in at 4%. That obviously is incongruent with the headline inflation of 2% that the Fed is targeting. So if we get those kind of numbers, it's not going to move the dial very much on the Fed pricing, Tom.
OK, so we're watching the hourly earnings numbers out of this data set. Really important, of course, in terms of the guide for the Fed. 240,000 is the top line. Ben Ram with the analysis. Thank you very much indeed. So we check in on US Treasury. You got the 2-year at 4.88. Yields just up 1 basis points. But, of course, we've seen those move in the opposite direction over the last few days. MLive's Ben Ram with the analysis. There is plenty more coming up. Stay with us. This is Bloomberg. Welcome back. Now, the UK's Labour opposition party has taken another parliamentary seat from the Conservatives. Labour easily won the Blackpool South by-election, and the Tories are also losing ground in the local elections with key mayoral results yet to come. Very pleased to say I'm joined now by Adam Blenford, Bloomberg's managing editor for the EMEA news desk. Adam, just how bad has this been for the Tories?
Good morning, Tom. This is one of the worst by-election swings from the Conservatives to Labour in history. I think it's the 3rd biggest. It was, I think, a 26% swing. And, that really shows that despite Sunak talking recently about wanting to mount one of the greatest political comebacks in history, the fact that they've been more than or around 20 points behind Labour in national polls recently, this kind of result suggests that those polls are indeed accurate and that the Tories haven't really made any headway at all with voters at this point. They've also got many thousands of local election seats being contested. Early results are only just in. It's going to be a long process before we get a full picture of what's happening there. But the Conservatives are down by about in the top of the last hour by about 122 seats or something, and they're still expecting to lose hundreds more council seats across the country, as well as control, indeed, of several councils as well. So they're expecting to face heavy losses, but all of that's been expected. But so far, no real signs of the Conservatives bucking the predictions that they would be in for a tough set of election results this time around.
OK, Anna Blenford, Bloomberg's managing editor for the EMEA news desk, on the latest that we're getting, of course, in terms of the votes and the results coming through. And, of course, we are unlikely to have the full picture until some point on Sunday. As Adam was outlining for us, it has, of course, been a challenging, to say the least, night for the Conservatives. Not a major surprise there, given the poll lead that the opposition Labour Party continues to have, plus 20 points. And we still wait, of course, for the date around the general election. But the read across to that general election, of course, from this will be crucial. Coming up, French banks are having a good morning, with Crédit Agricole and SocGen both beating first quarter earnings expectations. We break down the European banking sector next. This is Bloomberg. Apple jumps as it forecasts a return to sales growth. The iPhone maker announcing a $110 billion share buyback. That is the biggest in US history. Traders pull forward Fed rate cut bets by a month to November ahead of today's key US jobs reports. Plus, SocGen soars as all revenue from its equities traders help the French lender beat profit estimates. Good morning and welcome to the Pulse. I'm Tom McKenzie in London, and it is the banking story that is giving a lift to the European equity space today. Yes, tech is having its play as well, thanks to Apple, but you look at the CAC current and the lift coming through from Crédit Agricole and SocGen is pronounced. So let's stay on that story and unpack what's been happening in the European banking space then. Both of those companies, both of those lenders, Crédit Agricole and SocGen, in the green, and solidly so this morning after reporting first quarter earnings beat. European banks, of course, still facing some pretty challenging issues, including pressure to cut costs and possible downward movement on interest rates, of course, with the ECB expected to move in June. At this point, very pleased to say we can bring in Anke Reingen, the co-heads of global financials at RBC Europe, for a deep dive on these European banks. And Anke, I know you've been following this since Deutsche Bank on Friday, so it's been no doubt a busy week for you and the team through this week. Top line, what is the impression that you get? What is your take in terms of the health, the resiliency of this European banking space, and whether that resiliency, if that's what we describe it as, can be sustained in the quarters ahead?
Yeah, so I mean, it was really like eventful 2 weeks, I can say. And I mean, I think the key thing is that we really post Q1 results, so earnings upgrades. And that was coming from a number of sides. I mean, interest rates are staying higher for longer, which has helped. The banks kept costs under control, and also asset quality has been quite resilient. Capital distributions were somewhat expected, but clearly the banks are offering quite an attractive yield. But to your point, what comes next, and what comes next for bank share prices? I mean, the rate cuts are imminent for the end of the year in various regions. And I think the key thing is here, there's still an element of rates being higher than in the past that help net interest income going forward from the hedge effect. Plus, there's the expectation that if rates come down, volume growth can pick up. So that can offset probably some of the headwinds of the lower rates. And plus, what was quite really encouraging in the Q1 results is that other revenue lines like fees, investment banking, asset management, also quite good momentum. So going forward, there seems to be good momentum. But to your point, I mean, the share prices have gone up. Yeah. And valuations are probably less compelling than in the past. And also, to your point, there is still economic uncertainty, and we certainly have some events later this year which could impact market volatility and valuations. So we're probably more selective on a stock basis, but I think there's a good reason to be constructive on the earnings momentum.
Okay, really interesting. The momentum's still there. There's the potential challenges, but it sounds like you could also get a scenario which you're outlining potentially of a bit of a sweet spot for these lenders in terms of slightly lower rates, maybe trading activity picking up as well. On the trading front, the equities desk of one of the French banks today performing very well, even as fixed income was a little softer. How much activity? Are we at a turning point in terms of the capital market, in terms of IPO, M&A? Is that coming back with force this year?
I mean, it's certainly, Q1 trends are very strong and the pipeline seems to be building. So I think the market is still very fragile and there's probably a seasonality in the trends as well. But so far, so good. I mean, it seems to be some M&A building, ECM, and that could be supportive. I mean, on the corporate lending side, the volumes are still relatively muted and that probably needs an acceleration in economic growth. But capital markets seems to be more constructive in positioning.
And on M&A, Sabadell, BBVA, it's a potential takeover. Hasn't been confirmed, hasn't been locked in. I just wonder the broader signal it sends, potentially, about that long-awaited for consolidation within European banks. Is it a catalyst?
Yeah, I mean, I think there's some peculiarities to, because BBVA tried to combine with Sabadell before. But I think it definitely will bring back the debate on domestic consolidation. I'm not sure it's a catalyst, but there's definitely going to be in focus. OK, and on the buyback story, which has proven some momentum as well for the stocks of these companies, 2.5 billion coming from ING in terms of euros. That's just one example. HSBC coming through 3 billion. As you said, not a big surprise. It was expected. But does that continue? Do they have the balance sheets to continue to be able to hand cash back to shareholders in the quarters ahead? Is this sustainable? I mean, some of the excess capital has been eroded over time as banks have returned. But as return on capital is strong, that generates capital and can be distributed. And I mean, buybacks are obviously a nice yield, but also help the EPS growth. So in a favourable operating environment with earnings growth, I think they're sustainable. I mean, the uncertainty is always regulation, but hopefully in Europe the cloud is there's more visibility. On regulation, I wonder if you have a view on this, because the UK obviously about 6 months ago lifted the cap on bonuses, and we've seen HSBC, the AGM is going to happen, Goldman Sachs pushing through and removing that cap. Just broadly, without necessarily talking about individual banks, is there a challenge that the UK is posing now to European lenders in terms of attracting talent? Do you see any material change as a result of those adjustments around bonuses that could see some UK lenders being a more attractive place for some of that banking talent? I'm not sure that's the... I mean, I suppose you need still the business volume to generate that revenue and bonus, which is a function of revenues. Okay. So, I mean, it can be one of the factors. I'm not sure it's the deciding factor. Okay. And just briefly, before we let you go, you touched on some headwinds for the European banking space. What stands out to you? The things that could concern you, the things that could trip up these banks in the months ahead? I mean... Yeah, economic growth is still very fragile, and clearly some of the countries are not growing very strongly. And I mean, political, we have a few elections coming up, and volatility is good for trading, it's not so good for investment banking and consumer and corporate confidence. So I think that's probably the biggest, but there's always something unknown coming around. Yes, absolutely. OK, so the macroeconomics, the politics, and maybe some black swan events. But so far, it seems the ingredients are there, potentially with all those caveats for further momentum for these European banks. Really smart analysis from Anke Reingen, co-head of Global Financials at RBC Europe. Now, some of London's top bankers might soon have a paycheck that looks, we touched on this, more like the bonus-heavy packages of their New York counterparts, with Goldman Sachs paving the way. Shareholders at top UK banks set to vote on pay practices at their upcoming AGMs. The decision comes after a cap on bankers' bonuses was scrapped to make London more appealing.
Wall Street-sized paydays may soon be coming to the City of London. It's been 6 months since the UK lifted a cap on bonuses that limited them to 2 times a banker's base salary, a legacy of the financial crisis, and a far cry from the millions that top deal makers and traders in New York can make. Now it's up to the shareholders at banks, including HSBC and Barclays, which will be putting the matter to votes at AGMs. If the proposals pass, the process of rejigging compensation could begin in time for next year's bonus season, which Wall Streeters have historically counted on to pay for elite private schools, luxury holiday homes, and the most expensive cars. The cap was scrapped by UK officials battling to maintain London's preeminent position as a global financial centre in post-Brexit Britain. Overhauling pay could have consequences at home and abroad. Senior UK bankers who had fixed salaries increased to circumvent the cap could now potentially face reductions. And European rivals could find themselves at a disadvantage when hiring.
It's certainly a concern when regulations in the US and the UK, where we are active in a number of our businesses, start to move in a way that places European competitors at a disadvantage.
Top proxy advisors are recommending that HSBC and Barclays shareholders approve the measures, a sign they're likely to pass. No longer will city rainmakers feel like the poor cousins of Wall Street.
OK, coming up, you do not want to miss our interview coming up with the Governor of Virginia, Glenn Youngkin, as he visits Europe on a trade mission. That conversation is next. This is Bloomberg. Welcome back. Now, it goes without saying, it is, of course, a pivotal year for US politics as President Biden and former President Trump face off in a 2020 presidential election rematch in November, of course, of this year. Plenty of voters to think about, of course, when November comes around, with economic issues, including the cost of living at the forefront for many. Very pleased to say right now, to talk about all these issues and a trade mission to Europe, Glenn Youngkin, the Governor of Virginia, visiting Europe on this trade mission. It's the third international trade mission, then, Governor, for you in your role. Germany, Denmark, Finland, Switzerland. How do you define success on a mission like this?
Well, first of all, thank you for having me. And we have had a tremendous trip to Europe. We've seen great companies. We've seen political leaders. And success for us is defined first by deepening relationships. We have a number of great companies that have been in Virginia for 30, 40, 50 years that are headquartered in Europe but have their U.S. headquarters or manufacturing in Virginia, but also new relationships. And it's also been a great time for us to meet new companies that are interested in coming to Virginia. And we've had a couple really great announcements. $400 million investment in Virginia yesterday out of Denmark with 150 new jobs. But on top of that, we've also been able to glean real insight into macro trends. And of course, I've heard, Tom, over and over again about the tremendous risk of China and the need to be invested in the U.S., the need to make sure that power is reliable and affordable and increasingly clean. And of course, talent is at the forefront of all discussions. And Virginians are the home to the best talent in the nation. And that's why people want to be there.
Really, really interesting. Of course, you have the economic outperformance of the US as well, the Inflation Reduction Act. I wonder, in terms of the reliability question, Governor, is the US still reliable? Will it still be reliable after November if you get a President Trump in office? There's deep concern, we know this, in European capitals about where President Trump stands on things like NATO, on Ukraine, on trade, indeed. Has that been a topic that's come up? Is that concern justified?
Well, I think people look back at the rip-roaring economy that was built during the last Trump administration and would fully expect that President Trump, should he be elected, would build a rip-roaring economy again. And of course, the challenges that we have in the U.S. economy today are underpinned by high inflation and low growth. And I see it every day. Virginians are struggling. They're living paycheck to paycheck. The grocery store prices have gone up 25% over the last few years. Gas prices are up 50%. This silent thief of inflation is really causing challenges. And so we need the opposite. We need low inflation and high growth. I believe that's what President Trump built his last time. It's an economy that people remember very well. And that's the economy that we need to make sure that international companies are investing into. And Tom, I think at the heart of this is the recognition that the threat of China around the world is driving particularly European businesses to understand that trusted relationships, supply chains in these most critical industries like semiconductors, like pharmaceuticals, like electric vehicle batteries, and the need for advanced storage are driving people to want to invest in the United States, grow businesses in the United States, and deepen the already great relationships that we have.
And so, therefore, presumably, you would lobby against tariffs on European businesses, on the European economy, if that's what comes through from a President Trump.
Yeah, of course, the issue of tariffs is something that was used effectively back in the Trump administration in establishing a real recognition that China was competing unfairly. China continues to compete unfairly, and it needs to be combated. And that's why the deep relationship with trusted allies is so important. Listen, the bottom line is we need to make sure that open access to markets goes both directions. And one of the things I've enjoyed the most is the recognition from so many European businesses that investing in the United States and developing a strong platform for research and development, for manufacturing, for distribution, for aftermarket support is so important. You know, one of the things we've seen in Virginia, which has been so exciting, is companies like Steel from Germany have been in Virginia for 50 years. Their U.S. manufacturing hub is there, their headquarters is there, their service centers are there, and that's what I think that's what companies are recognizing the U.S. offers, and particularly Virginia.
Okay. Governor, on the politics of the US, and we're seeing this, of course, across campuses at universities across the US, not just in your home state, but it's happened as well. We saw some violence at Virginia Commonwealth University in Richmond, not far from your governor's mansion. What actions would you be prepared to take if that kind of violence flares up again?
Well, at the heart of this, first of all, is a real commitment to freedom of expression. It's in our First Amendment, in our Bill of Rights to our Constitution, but it needs to be peaceful. And these demonstrations have crossed over peaceful in a big way. And what we've, of course, seen is non-students causing real problems, non-students inciting hate speech and anti-Semitism and violence. And so we preemptively went to work with our Attorney General, Jason Miyares, in Virginia, law enforcement, leaders of our universities and colleges to make sure that we tried to preempt this. We would not allow encampments and tents. We are not allowing hate speech. And if they're peaceful, then, of course, that's part of our constitutional right and part of the American fabric. But we can't allow hate speech, anti-Semitism, and most importantly, violence and disruption and threats. I think we've been effective in coordinating this, and I'm hopeful that we can continue to make sure that the safety on our university campus is paramount.
Former President Trump describing the white supremacist rally in Charlottesville, Virginia, of 2017 that we all remember so starkly as peanuts compared to these university protests. Is that the right way to characterize it?
Well, I think one of the big priorities that we've had is to preempt and to make sure that violence doesn't even get started. And that's why this coordination early on with our Attorney General, with law enforcement, and with university leadership has been so important. And, you know, what we saw, of course, at Virginia Commonwealth was a large introduction of outside element. They were bringing supplies. They actually brought water bottles that had been filled with bear spray. They were organized to try to confront law enforcement. And I don't believe that's the students. I think that's outside influences. And that's why it's so important that we're coordinated in a preemptive way to make sure that everyone stays safe.
Are you worried more generally about political violence and civil unrest in and around the November general election in the US?
Well, again, I firmly believe that the ability to freely express one's views is so important. It's part of America. It's part of our constitutional freedoms and rights, and we must protect those. But there are real boundaries, and when threats are made and violence ensues, then we can't allow that to happen. And we've seen that when it goes unaddressed, we can have situations like we saw up at Columbia, or we saw out in California this week, where violence ensues, and we just can't allow that to happen. Most importantly, there is an absolute safe place of freedom of expression that we need to ensure, but we must draw boundaries on what we're not going to allow, and intimidation, hate speech, and violence won't be allowed in the Commonwealth of Virginia.
Another lightning rod issue for voters, it seems, is abortion, reproductive rights in the US. And it seems like at the ballot, voters are sending a pretty clear message that they want to keep reproductive rights. And you saw that in your own state, Virginia, last year. Are voters telling you that Republicans are on the wrong side of this issue?
Well, first of all, this is an incredibly emotional and difficult topic across the United States. And with the Supreme Court ruling now 2 years ago almost, states have taken up, I think, the appropriate responsibility. What we tried to do in Virginia was find common ground, to find a place that was reasonable. And I think that discussion is really important for us to have. And I'm committed to continue that discussion because I do think that it all starts with hearing one another and making sure that we first understand that, yes, this is an incredibly difficult topic. And second of all, there is a reasonable place to land. And that's the place that I can continue to work with our General Assembly in Virginia to try to find.
Governor Glenn Youngkin, Governor of Virginia, really appreciate your time this morning as you wrap up that trade mission, of course, to Europe. And we look forward to welcoming you here in the UK at some point later this year. Sir, thank you. Now, coming up, the Spanish company PUIG Dynasty launches what is set to be the biggest European listing this year. We bring you the details next, what it tells us about the revival, potentially, of these capital markets. This is Bloomberg. Welcome back. Now, Spanish Dynasty, the PUIG family, is launching what's set to be Europe's biggest listing this year. Shares in the beauty and fragrance firm start trading today after raising 2.6 billion euros. Let's bring in at this point then Bloomberg's Sweta Gopinath for the details, what it tells us about the capital markets. How significant is this then, Sweta, for the broader IPO market?
It's pretty significant for the European IPO market. It's the largest listing, like you said, we've had this year in Europe. It's the largest listing, actually, we've had in Europe for a couple of years now. The European IPO market is slowly bouncing back to life. Actually, looking at sort of year-over-year numbers, it looks like, in terms of IPO proceeds, the market's already doubled in size. So it is a sign of more to come, hopefully.
There's more to come. There's more in the pipeline. What are you looking at? What are the gauges in terms of the future and what it tells us about that IPO pipeline then?
How PUIG trades today, that's going to be a marker. Everybody's going to be watching that pretty closely. It's a big deal. They're priced at the top end of their initial price range, which is good news, which means that there's a lot of investor demand for it. But if that actually trades into good gains for the company in stock market trading, that remains to be seen. We'll know in a couple of hours now.
What is driving that demand then? This is a company that has consumer brands in an environment where the economy arguably is challenged. People are feeling the squeeze on many fronts. What is driving the demand for PUIG's offering?
I think it's in that sort of premium high street category, right? Sort of soft luxury, as they call it, right? They have really good brands. They have Jean-Paul Gaultier, Charlotte Tilbury, sort of household names. They were very big in perfumes. Now they've moved into beauty brands. It's a really old company, a 110-year-old company that's sort of flown under the radar given the names they own.
Yeah, absolutely. Soft luxury, you said. Is that the way you described it? Soft premium.
It's probably not the right phrase, but
I like that. Premium, soft luxury. Yeah. All right, and it's driving this demand, and of course the signals about what it tells us for this capital market. They may be finally turning around. So we'll watch the pricing, of course, later today. Thank you very much for the analysis on the broader implications then of this IPO, the biggest one in a couple of years for Europe. Sweta Gopinath, of course, from Bloomberg. We will check in now in terms of the mining space on Anglo American because that stock's taken and had a bit of a pop. This is on the back of reporting from Reuters, reporting that Glencore is studying an approach for the miner, citing two unidentified people familiar with the matter. And, of course, you're seeing that move now, up 3%. And, of course, what it could do is juice up that takeover battle then, potentially with BHP, which, of course, came through with the first offer, which Anglo rejected. We're also going to check in on Apple, of course, coming through with that update, a more positive update in the current quarter. And you're seeing investor relief maybe being described, given the concerns around this company's exposure to China, up close to 6% right now on Apple pre-market. That will be a story for our US colleagues as well. Bloomberg Brief is up next. This is Bloomberg.